I want to say welcome back to you, Weston Nakamura, our own member of the Real Vision team. Good to see you.
Hello, gentlemen. Thank you for having me on and allowing me to intervene, into your RVDD today.
Good joke, Weston. I also want to say welcome to Tavi Costa, the portfolio manager at Crescent Capital. It's good to see you, Tavi.
Good to see you too. Thanks for having me. Looking forward to this.
So I wanted to start with the sort of biggest breaking news of the day, the intervention in the Japanese yen market. It was essentially that intervention that led me to ask the question, is it time for a fierce reverse FX war today? Weston, if we start with you, please give us the overview of what happened earlier on today in the Japanese yen market.
Sure. First of all, to answer your question, yes, in terms of FX war is my response. But let's just rewind 24 hours ago. Okay, so we have FOMC hike rate 75 basis points, and Powell being very clear about being hawkish. About 10 hours later, you have the Bank of Japan, who had their policy meeting, no change. This is like the 50th or 60th straight meeting in which there's no change in policy. And then the Bank of Japan policy statement comes out around noon in Japan, and then BOJ Governor Kuroda's press conference comes at 3:30 p.m. after cash close. Tomorrow's Japan holiday, so it's actually kind of ahead of a long weekend and all that. But in between that time, you had the Ministry of Finance come out and once again, just basically do what they've been doing for the last really like all year long, but really intensely for the last month or so, which was to jawbone the yen stronger as it was starting to break through that into the 145 handle after the policy itself came out. 145 seemed sort of as a potential line in the sand, and they were talking about doing like stealth intervention and all that. It's not very stealth if you're like talking about it, first of all. And then 3:30 p.m. Kuroda gives his press conference, and this is where you see the most stark sort of, example of central bank policy divergence, because you just had the Fed, like I said, be very clear about what they're doing. They're going to be hiking rates. They're going to tackle inflation. And then Japan and Governor Kuroda saying during his press conference, not only is the BOJ going to maintain their accommodative policy with the yield curve control, 25 basis points for the upper band, this and that, whatever, but he also made a comment saying, we're going to keep this for like a while. And by that, I'm not talking about 2 to 3 months. I'm talking about 2 to 3 years. And so that's something that, that's a hell of a lot more dovish than people really had expected. By the way, Kuroda's term ends in April of 2023. But nonetheless, though, that's pretty insane guidance, right? Going completely the other way. And so naturally, what you would expect to see is for dollar yen to move higher as that policy divergence continues to widen. And so maybe about 10 minutes after Kuroda's press conference wraps up, the dollar yen basically makes about a 5 yen crash, like one way downwards, from about to hit 146 into the 140 handle in a space of about a half an hour or so. And it was revealed that the Ministry of Finance had said that they had intervened in the FX markets. And so this was not, that crash itself was not them intervening. It may or may not have been, but that was the reaction to the announcement itself. So that's what basically happened.
A pretty interesting backdrop. I want to include you in this discussion on foreign exchange markets as well, Tavi Costa. This very weak Japanese yen and the response from the Japanese authorities, is it something that's on the radar for Crescent Capital as well?
We're short the yen, and I wish I was short the yen for the whole year. And I was, I thought that they were going to intervene a lot earlier, to be quite honest. So it surprised me as well. I think there's a lot of interesting FX transactions and opportunities that I think it kind of fall into this framework of believing, if you're in the view of we're entering an inflationary environment, which is my view, where there's some crossing of FX that look quite interesting. I think we're talking before the show started on the Brazilian real, for instance, relative to things like the Japanese yen, relative to things like the CNH. it's incredible to me. We're seeing the dollar move recently along with this move in interest rates. And if I can think of two things that could actually blow up the whole global economy, that would be the two going together. So to me, it's hard to believe we can see those moves sustainably. And so from a dollar perspective, I am a dollar bull in general, but I do think we're going to see some sort of coordination of central banks in general to not allow this to continue. It was quite interesting the way the U.S. Treasury actually took this level of this intervention news from the BOJ very openly, actually. So to me, I think this is it continues to fall into looking back at those macro imbalances that we have currently that I think create the political constraints for central banks in developed economies. It's the first time we're seeing inflation in developed economies with such a large amount of debt in many, many years. And the problem here is, we've been calling this a trifecta of macro imbalances, mostly in the US, but you can apply the same idea in other places. Japan, maybe not so much on the valuation side. The trifecta really means it's a debt problem, it's a valuation problem, it's an inflation problem, all happening at once. We've seen those happen in the past, but not all at once. And those are real political constraints when it comes to a bank like the BOJ, a bad importer of commodities, that makes a trade balance extremely fragile relative to a country like, let's say, Brazil, a commodity exporter that is not as indebted as Canada or Australia and so forth. And so I view this as a change of balance of powers. There's a lot of opportunities will be unleashed from those this sort of long view of macro imbalances. Those can be many. I mean, it could be emerging markets that are commodity-led economies to benefit. Those are the 60-40 portfolios, the end of that, and a new portfolio approach of including commodities and other things that are tangible assets that can actually benefit from this. And I think that the FX market itself is not priced into a world like that in many ways. And some of the crosses, as I said, Brazilian real versus Japanese yen is something. If you look at a chart of that over the last 30 years, it's just an amazing kind of a base being formed recently, which I think is poised to go much higher. So to us, it's more of a we've been looking for ways of hedging or long inflation book with the issues that we see globally, and some of them are in the dollar world. It's the Chinese yuan, it's the Hong Kong dollar that never broke the peg, and it's such a cheap way of exposing your portfolio for kind of a tailwind type of event. And so we've been increasing our shorts in the CNH more recently. We've decreased our shorts in the equity markets today, to be honest, just today, just right now, we've been decreasing a little bit. Increase or shorts in the CNH with the dollar, and that's really our main play in order to hedge that long producers, long tangible assets part of the book, which is very large for us at least. And so we've been looking for ways to not get in trouble with that part of the book.
Interesting, Tavi. I want to get back to that discussion on portfolio construction in an era of inflation, because it's certainly not a 60-40 portfolio that will work in your favor in such a scenario. I perfectly agree with that conclusion. But before we get to that, Weston, I want to understand who's behind this intervention in Japan, because it seems as if the Bank of Japan is sort of unwilling to follow other central banks in terms of rate hikes and in terms of reducing the balance sheet size. So what's going on in Japan? Who took this decision?
Yeah, unwilling is one way to put it. So just as Tavi mentioned, so the U.S. Treasury Department comment from spokesperson was, the Bank of Japan today intervened in the foreign exchange market. We understand Japan's action, which it states aims to reduce recent heightened volatility of the yen. That's what you got out of the Treasury Department. The reason that matters is because the intervention that happened today is not like a real intervention, as in it was done unilaterally, and this was not done with cooperation of G5 counterparts, or at least with the permission, if not the consent and sort of approval of the United States Treasury. This is so when people are, you're seeing like right now a lot of media headlines saying like this is 1997, 1998. This is the last time that Japan intervened. It's not that at all, because when that back then in the late 90s, when that intervention happened, that was done with the expressed consent of then Treasury Secretary Rubin and Tokyo working in coordination. And so what they do is, what the U.S. and Japan does is, their respective, Department of Treasury and the Ministry of Finance, they're the ones who make the decisions to, fix the yen against the dollar at whatever price or whatever they're aiming for, whatever direction it is. But they execute it through their central banks. So so Treasury Secretary Rubin will tell the Fed to sell dollars, buy yen, and the Bank of Japan will also take directions from the Ministry of Finance and essentially do the same. So when people say that the Bank of Japan stepped in and intervened in the markets, technically yes, that's true, as in that they carried out the execution itself. But they're an agency. They're not doing it themselves at their own discretion. That's from the Ministry of Finance's decision. What the Bank of Japan is doing as a prop book, if you will, so Bank of Japan is basically acting as a sell side, and the Ministry of Finance is like their client, the buy side client. What they're doing in their prop book essentially is they're supporting the rates market, and you could only do one or the other. You either support the JGB market at the expense of the yen, or vice versa, which is what basically the vice versa is kind of Hong Kong, right, and the peg. So basically, just from the 90s, what happened was that even with the consent of the U.S. Treasury Department and having this be official and in written statement and all that, it still doesn't really work if fundamentals aren't there, right? So back then you had the selling of dollars and buying of yen from both sides, from Tokyo and from Washington, or the New York Fed rather, and dollar yen dropped like 10% in 3 days, but then it reversed like sharply, back right back to where it was almost. It did mark the 146.80 high or so, which we're about to kind of pierce through. But that's what happened when there was like coordinated intervention. And what's happening right now is not that. What you're getting out of the Treasury is a statement of acknowledging like, yes, we recognize that happened. And what I think is also happening too is that you're getting sort of like brush off like consent, if you will. You're not getting problems from other central banks and from the U.S. because of this like ripping high dollar, right? So Japan doing this, it's not really material, but you did see actually like the G5 currencies against the U.S. dollar strengthen alongside JPY when that did happen, and so that kind of takes off pressure from everybody. It kind of perhaps even the United States as well, trying to control the dollar. So I don't think that anyone would have too much of a problem doing it. I just don't know how particularly sustainable it is, given that the previous intervention was not very sustainable. And it just comes back to fundamentals. If the fundamentals are not aligned, it doesn't matter what the officials say. The officials will say, we're intervening in the yen because of volatility and because the yen is not trading on fundamentals. It couldn't be more fundamentally, like price action oriented right now. You have a Fed hike, you have the Bank of Japan on pause, you have a widening policy divergence, you have U.S. Treasury yields, nominal yields ripping higher, yield spreads widening, and so dollar yen is going to naturally move higher. And so for them to say we are doing this because the volatility and the speculation, the speculative activity and all that, I don't see how a state actor coming in with non-economic sort of a non-economic state actor coming in, intervening into foreign exchange markets and creating a net 5% swing in the space of half an hour or so is fundamental and stable by any means either, let alone stealth tapering, right? So my sort of conclusion of all this is that as long as US and DM yields keep rising, as long as Bank of Japan maintains JGB yield curve control, which they just reconfirmed that they do, and as long as markets' concern is more on inflation than it is recession, and as long as Japan energy imports, and demand is up and prices of energy imports continue to rise, and as long as the other sort of G5 counterparties are not willing to sell dollars and euros and pounds and all that, because they're all trying to fight their respective inflation and not and deflect inflation away, then dollar yen at some point by fundamentally is going to hit that 150 mark, likely before it hits 130.
Yeah, makes a ton of sense. And maybe I could add that as long as the Bank of Japan prints fresh Japanese yens to buy bonds, it's kind of
you
counterintuitive
print yen to buy yen.
Yeah, I mean, it doesn't really make any sense. If you tried that in an Excel spreadsheet, you would probably get a circular error, right? So, I mean, yeah.
Can I just add one more point too? Is that I just want to talk about say why I think the Ministry of Finance is doing this. Like, it does seem very kind of idiotic almost. But they're doing this because essentially the Ministry of Finance is trying to buy time. They're trying to buy time enough. They're trying to basically scare the market. I don't think they did enough. If you're going to do it, go big or go home. They should have just kept on hitting the bid and slamming it down, so you get 10% down on dollar yen in an hour or whatever it is. But what they're trying to do is essentially just scare markets, so that you don't have a momentum runaway in dollar yen higher. And they're just waiting for the Fed mostly to just pause. And if they can buy themselves, they're probably thinking, till 2023 or so, or probably maybe off of dot plots, whatever it is. If they can just buy themselves a little bit more time, because they know that Kuroda is going to just stay put with his yield curve control and can execute on it, that's what they're trying to do essentially. But again, I just don't know how sustainable that is. But that's what the intention at least is.
Yeah, and Kuroda retires in the spring of 2023, as far as I'm concerned, Weston. So just around the corner. Weston, I'll allow you some sleep. Thank you for joining us and unpacking this action in the Japanese market earlier today.
Thanks so much, gentlemen.
Tavi, back to you. Weston spoke about this potential coordinated action against the strong dollar. How likely a scenario is this in your view?
I think it's very likely. While we're long the dollar, we're not long the dollar anymore against the euro or the Japanese yen or most of the other developed economies. I just can't think of a world that can really sustain this level of a move. I mean, if you think about corporate earnings, I think I have a chart on that, which I think it's been other folks have done different charts similar to that. I think it's chart number 5, just looking at corporate earnings revisions globally versus DXY inverted, and this chart needs to be updated. DXY is actually a lot stronger than this. It's hard to believe we're not going to see fundamentally weaker earnings in general globally, especially here in the US as well, with companies that have so much of their revenues outside of the US. And this is all, it's all, to me, it's all interconnected. I mean, thinking about this move on the treasury market, I mean, the treasury market to me holds the key for the whole market. I mean, it's what's causing this interest rate differentials across many different economies. It's causing, even from a monetary policy spread that we're seeing across different places. It's not just the large developed economies, but there's sort of the risk of something like that happening in places like China, which I hate to use the term, having their Lehman Brothers moment, because that sounds very maybe catchy for Twitter, but it's so unique what's going on there compared to what happened in the US. And I'm not trying to move away from the Japan discussion, but it's they're all involved here. It's hard to believe we're going to see a continuation of that move, and so I wouldn't be. And it's not a position for us, but I do think treasuries have more to go to the downside. We're not adding to our position today. We're out of the treasury shorts as well, and we've been just heavily betting against the Chinese yuan at this point.
Interesting takes, Tavi. You briefly touched upon the classic 60-40 portfolio, so 60% equities, 40% bonds. Bonds usually working as sort of a cushion against drops in earnings and the sell-off in equities. What do you make of that 60-40 portfolio in an inflationary environment as the current one? It seems to be slaughtered day after day, right?
It's amazing what's going on. I don't think anybody ever thought that a move like that would happen. I mean, imagine if you're a pension fund, kind of having to deal with this change in correlations. I mean, the correlation that we're facing today is quite different, and it's not just the 60-40 portfolios. It's also global bonds versus, call it, gold. I mean, they used to trade very close to each other too, and more recently are having a big divergence. I think that's on chart 7, and it's to me, I mean, there's a lot of changes right now happening, and it's every now and then you got those pivotal moments, and it's kind of sort of a hubris on my end to think that we can call this after 30 years of a macro regime that is now changing. And so you just kind of have to slowly get into that view. But you could see it from many different fronts. I mean, perhaps inflation was overdue, but the pillars of inflation today are just so sustainable, in my opinion, and so entrenched in the economy that it's hard to believe it's going to stop. I mean, I call it the 4 pillars of inflation, Andreas. I think it's the wages and salaries growth. Those are difficult trends to reverse back to normal, like we saw in the last 30 years in a declining trend. I think that's a secular move. I could be wrong about that, but then you have the second pillar, which is the natural resource, chronic underinvestments in those industries in terms of the capex trends. I could be wrong about that too, but those take forever to move. And with the political effort and how management firms are really being pressured by shareholders to not spend capital on new developments of commodity related projects, it's hard to believe that's going to change. The third one has to do with the fiscal spending. I mean, the fiscal spending today, even though it's lower, thinking about the delta from 1 to 2 years ago, yes, there is certainly a negative delta there, but relative to other times in history, what we are spending today relative to GDP or even relative to what we saw in the 60s and 70s, there was actually some sort of a sense from policymakers that created inflation. Government spending was related to being a tailwind for inflation. I don't think that that's really the view here. I mean, people are still talking about green revolution. You have the peak inequality problem. You have the situation of having reshaped the manufacturing plant in the US. That's all going to cost money. And then the fourth one, which, as you've been in that debate as well of is this the 40s, the 70s, or no, this is just unique or whatever. I mean, to me, what was important to look back in the 40s and why I've never been much of that view, even though I respect that view, it was really because of at that time we were finishing a period of a very deglobalized world, and I think we're at the beginning of one today. And so, to me, it's a huge pillar of this inflationary problem that is, again, just getting started from many different fronts. I mean, you can talk about Russia and Ukraine. You can talk about what's happening in China versus the Western economies. You can have a discussion about the Middle East as well, and other oil dependent economies and so forth. I mean, there's so many things moving right now in the geopolitical environment that it's hard to believe that's not going to have an impact on inflation. And so, yeah, I mean, I think this is the beginning of one, and it's never clear, but it certainly looks like it is the beginning of one.
I can add a bit of anecdotal evidence in relation to your point on the underinvestment in the energy sector. I think right about every pension fund and asset manager that I speak to in Northern Europe have been asked by either their board or their members to defund every single project within fossil fuels over the past, say, 3 to 5 years. And it probably takes a while to reverse that trend, even though it will probably become a bit tempting, to say the least, in Europe to try and reverse some of those trends due to the lack of energy, simply speaking, heading into this winter. If you were to form a portfolio, and now I allow you a blank sheet, Tavi, into an inflationary environment over the next, say, 1 or 2 decades, let's just assume that, how would you construct such a portfolio?
Well, I would start with, maybe we can look at the chart 12, which is looking at commodities to equity ratio. I mean, everyone has been using that chart for so many years, and that chart never moves. But I think finally we're starting to move in that front, meaning there's almost like two bombs setting off on those two parts, the commodities trade and the equities trade on the short side. Well, if it's a long short portfolio, if it's a long only portfolio, let's start there. I think there's different ways to express your view. Number one, I would put a large allocation towards mining. I think there's a lot of opportunities and inefficiencies in precious metals and base metals, especially across. You can separate the whole industry, right? There's explorers, there's developers, and there's producers. Majority of folks that are financially savvy like to navigate in the producers and developers. Developers, you take more leverage, and then explorers is even higher leverage because the risk is much higher. But it requires a geologic knowledge to navigate that space. So I would, and that's what we've been doing. I would certainly, try to partner with someone that knows how to navigate the space from a geology perspective, and create a large portfolio of ideas there. Because I think the major companies in the mining space are facing a supply cliff, meaning they've been mining their reserves, they've been basically depleting their reserves and not replenishing them. So it's partially through political situation of pressuring them not to invest further in their developments. Also, there is a real pressure from shareholders, not allowing those businesses to invest in things that are not generating free cash flow. And that's the case with any exploration asset. They don't make any money. Now, don't fool yourself. They're not going to make any money for, 7 to 10 years. It is what it is in today's environment, especially. And so I would start with maybe, between 40 to 50%. I would certainly focus on that front. I would probably say another, call it 30%. I would separate in two buckets. 15% would be maybe energy. Another 15% would probably be on agricultural commodities. I like those plays. They have a shorter, cycle. Energy and especially agricultural commodities have a much shorter cycle. But energy still, what I don't like about energy is the fact they already had two big years. They had a big year in 2021 and had another big year in the beginning of 2022, and now it's having a little more trouble. So, but it's still a very cheap sector of the economy, energy as a whole. It's hard to believe it's not, it's not going to go higher. Let's call it, 3 to 5 years from now. And so I think that's a good, interesting investment. And finally, I'm leaving about 20% left. So about 40, 50% in mining, about 30+% in energy and agricultural. Call it about 20% left. I think I would certainly be looking at a little bit of allocation on uranium. It's why not more than that? Well, because I don't think there's really a supply cliff issue. There's enough supply of uranium. There's no supply story here in terms of that. It's really a demand and political shift that drives that narrative. And finally, where I think I'm growing my conviction, and it's something that if we see a pullback, let's say soon here with elections and so forth, and the Brazilian assets, I think Brazil is, I've always been a skeptic of Brazil, maybe because I'm from there. I've always been a skeptic of the political environment. It's extremely corrupted. I lived there most of my life, and so I have my biases, and I'm trying to put that aside. And because I do believe that, regardless of the political environment, the political leadership, similar to what we saw in the early 2000s, if we do see Lula coming in or anything like that, it just really doesn't matter much over the long term, because those companies are extremely cheap. You can buy Brazilian banks, you can buy Brazilian oil companies. They're trading at ridiculous multiples. I mean, I'm a little bit of a value investor. I appreciate a lot of cheap things, and I've never seen things trading at those multiples. And you can find banks trading at 3-4 times earnings today. Large banks, they extremely profitable organizations. And so I think there are opportunities in South America in general. So even that base metals and precious metals part of the portfolio, I think there is a space to be allocating capital outside of the U.S. In places like South America. I think will play a big role geopolitically in the future as well. So That's my answer. Now, if you want to go talk about long and short, I can get into that too.
I wanted to add, Tavi, that the first round of the presidential election is coming up the 2nd of October in Brazil, as far as I remember. And I will interview Miriam Dayub from Grimper Capital next week at Real Vision from Brazil to get sort of a view on whether this election will turn the tide on Brazilian stocks. I've been looking at Brazil as an investment opportunity all year as well. So really interesting take, Tavi. The last thing I wanted to touch upon now that we have a precious metal expert on board in the daily briefing today is the spot performance of gold and silver in this kind of environment, right? We've had our discussions over the years on whether to allocate towards precious metals in physical format or not. And I think you have a very interesting point when you look at the correlation between bond markets and gold, because unusual correlations between real interest rates and gold should have traded much, much, much lower by now. But something is clearly happening on the correlation front. So what's your take on the physical gold and physical silver in this kind of inflationary environment?
Oh boy, now you're pressing on something I've been very wrong. I've been betting on gold and silver for the last couple of years, I would say, it's surprising me at least. I think surprised a lot of people as well. And I think it's on the back of this major reversal of the Federal Reserve, going from slashing rates to zero, doubling the size of the balance sheet, to now raising rates to levels we haven't seen in a while. Especially the rate of change of interest rates has been on a 3-month basis or so forth. I mean, it's been, or 6-month basis, has been very drastic, I would say. But also the bond market, as you mentioned as well, is creating some pressure. And it's interesting when you have all this negative news as part of that. I mean, there are also positive news. Inflationary environment, gold should be reacting better. You can create the other side of this argument. I'm not going to pretend that there's not an argument that perhaps gold should have been reacting much better, especially with the war, breaking out and so forth. But we didn't see that. And that's just this backdrop of excess liquidity that we used to have, now changing to a withdrawal of liquidity in general, global central bank assets declining and so forth. And it's been difficult, but it's been of my view that, I think when you talk about this supply constraints on different parts of the markets, of commodity markets, now it's a popular thing to talk about. But in precious metals is real. I mean, and base metals is real as well. I don't remember the last time any of the major companies in both parts of that market have developed a new project in the space. And so the supply truly is very constrained, and it's becoming more and more challenging to find new discoveries. Just to give you a sense, last time, we haven't found really higher than 2 million ounces gold discoveries that are actually officially resources in the markets in many years right now. And so it's becoming a problem because it's really underinvestment and no focus in exploration whatsoever. I do think that gold is starting to sniff out some issue. I think that the global economy is imploding. I mean, it's hard to believe it's not going to, with the level of monetary tightening in such a fragile environment as a whole. And so I think that if we see that, that's really what could perhaps cause a trigger to change the policy stance. But I don't think we're there yet. I think we're yet to see more of monetary tightening in general, and yet to see as well this lagging effect of the tightening of monetary conditions still to play out here in the economy. As you know very well, most macro leading indicators have been kind of pointing to that direction, but we're yet to see things like earnings completely collapse. I mean, earnings are still near the top and things like that. When we start seeing that and start hurting, let's say, unemployment rates to rise and labor markets to deteriorate, and really changing that setup where it really forces the Fed to rethink about their policy, I think that's I think gold's going to start sniffing that a little faster than most people. And so I'm not changing that part of the portfolio because I don't think if there was ever a time when I could maybe lay out a plan for the next, call it 5 to 10 years, to invest on things that are more illiquid, but they have a major, potential for becoming world-class discoveries, which are not worth, tens of millions of dollars. They're worth, billions of dollars in a market like that. I think that moment is today. Like if, it feels like it's early technology space where not a lot of folks know how to navigate it very well. Like you're saying, people in Europe asking about investments in natural resources. Well, we've been trying to be that manager to acquire those assets. And one of the questions we get the most are just wrong questions. It's about lithium, which is extremely difficult to mine. It's about nothing that really I would say attracts us as a great opportunity. So there's a real lack of understanding in the space in general of how to invest in the space, and people are just chasing the large cap names, the middle cap names when they start buying those, but the real inefficiencies are not there. So you're able to buy companies that have discovery holes, let's say. So what is an exploration? Just 1 minute on that. An exploration company is a company that acquires land and they have mineral rights to that land, and they start drilling to find natural resources. They poke holes and look for mineralized intercepts. When they have those intercepts, supposedly the probability of having a discovery increases. So the value of the market should be higher, not lower. But today's environment is just so depressed that you can find a bunch of winning lottery tickets, companies that have discovery holes that no one cares. And so you can build a portfolio, kind of like a VC approach, buying all those companies that are likely to be finding great discoveries of whatever it is, base metals, gold, silver, but no one cares. And so you buy them out as a very large percentage of those businesses and wait until not only you can follow up and find those discoveries, but also the market, the macro backdrop, which could be incredibly favorable over the next years. And so to me, that's kind of like the optionality that I like to invest in. So that's why I continue to be very bullish in the space.
Interesting, Tavi. I've made it my trademark to always conclude the discussion in the daily briefing with a meme. And I needed a meme on the Japanese central bank today. So this is a meme of Kuroda watching other central bankers hiking interest rates. He is apparently still opposed to doing anything about the Japanese yen in the current situation. So it's important to note that the move in the yen today and the intervention in the yen today was sanctioned by the finance ministry of Japan, and it was really a one-sided intervention by the Japanese authorities. And to sum up on your discussion, Tavi, it feels like we agree that the 60-40 portfolio is stone dead in the current environment, with inflation running at levels that we haven't seen for quite a while. Then it's probably time to sort of reshuffle the portfolio to more real assets. So miners, energy, agricultural commodities, and stuff like that. Tavi, a great pleasure to host you. I think this was a masterclass daily briefing. So I really enjoyed interviewing you. Thank you.
Hey, thanks for having me, Andreas. It was a great pleasure. Thank you.
And my colleague Maggie Lake will be back with the founder of Real Vision, Raoul Pal, tomorrow afternoon. It's evening, my time in Europe, at the Real Vision Daily Briefing. So that's a must watch as well. See you tomorrow.